to our economic update webcast. I will be the moderator for today's event, and as always, our goal is to continuously add value for our clients by helping to educate you and keeping you informed. Today's discussion will be hosted by Roy Williams, CEO of Prestige Wealth Management Group, John DeAngelo, Managing Director of Prestige Wealth Management Group, and Paul Esposito, who serves as our Senior Portfolio Manager. This conference call will be in a listen-only mode and should last approximately 30 minutes. No participation is required, and there is nothing you need to do except sit back and relax. We will take care of the rest. We can't take any live questions during this call, but we do welcome your comments and suggestions. So at the conclusion of the call, please feel free to send us an email with your comments and or questions to pwm@prestigewmg.com. And with that, here's Roy.
Welcome, everybody. You know, we're having this conference call because most of you have gotten your statements and, you know, have seen that October was a pretty, I guess there's no other word but hideous month in terms of returns for the market. And, you know, Paul, to start out, you know, so we want to really discuss really what's happening, you know, so everybody has understanding.
Sure.
You know, September, you know, markets are great. October, we hit October and all heck broke loose. You know, why don't you talk a little bit about the volatility?
Right. Well, from a seasonal standpoint, September and October, by and large, tend to be two of the most volatile months for the market. So this year, given the fact that September was quite muted in terms of volatility, you know, it was a bit abnormal. The fact that August and September were markedly positive, given the backdrop of concerns about the Federal Reserve, concerns about trade, still, you know, give me some inkling of hope between now and the end of the year, because those 2 months tend to be historically at least confirming of positive returns in the market over the long run. But October, if we look at the amount of volatility, you know, the market volatility index that we follow, the VIX, typically has a historical average of about 20. So volatility being low on a scale of that VIX index, you know, 10 to 13 tends to be low, 20 tends to be average, and anything above 20, you know, 25, 30 tends to be abnormal or above average. We've seen bouts of volatility like this in the past. We saw it earlier this year back in February when we saw the initial drawdown in the markets, where the volatility index actually spiked well above 30. This last iteration of volatility has, you know, been a reading of about 25. I mean, today volatility index is around 20, which is heightened from where it was a few days ago at 17. But I think the bigger picture is we've been here before, and you know, as evidenced by the chart now that we're showing, it actually characterizes what volatility's been like for this year. What's driving the volatility? I think that's the important thing. And if we look at what drove volatility in February versus today, very similar, right? Concerns about the Fed raising interest rates a little bit too quickly and looming trade concerns, right, mostly with China. Now, we've resolved a lot of trade concerns with Mexico, Canada at the end of the third quarter, but the market is still focused on those two.
Even some of Asia, because South Korea has been agreed to also.
Correct. There have been some preliminary discussions to that extent with South Korea, with trade deals. Same thing with Germany. There have been some loose terms that have, but at least gives us a constructive view on where trade could potentially go. Now, we still have until the end of this month the G20 summit for the current administration to meet with President Xi to hopefully hash out a positive trade deal. So, you know, if we look at historical volatility relative to the markets and the market behavior, I think what's very important for us to identify is that heightened periods of volatility do not predict long-term market outcomes. They're very good indicators of looking at the drawdown effects of the market or negative sentiment in the markets for the here and now, but not good over the long term. If you look at previous market cycles, going even back to mid to late 90s, we've had large bouts of volatility spikes. And even with those large bouts of volatility, as you can see, as evidenced by the red line, which is the Russell 3000, which is a broad-based U.S. stock index, markets still have the ability to trend higher. Usually the worst time to try to reposition a portfolio more defensively or capitulate, we've gotten, a few client calls, concerning, should, they reduce their equity exposure at this point. I think the one thing that you can get from this chart is that when volatility is extremely high, it is probably one of the worst times to sell risk-based assets.
Meaning stocks.
Meaning stocks.
U.S. Senator.
That's correct. That's the worst time. It's actually one of the most opportune times to buy stocks. So, we did some repositioning back on October 30th, where we actually sold some fixed income, and we actually bought some equities across the portfolios.
And depending upon the portfolio, if someone was taking withdrawals, they may have not been rebalanced because of withdrawals, but for the most part, we did that.
That's correct, but we're refraining from selling stocks at these levels. Again, unless we have to, unless it's an inordinate distribution. But I think that's the bigger picture behind volatility in the long run. But let's look at, John, what is your assessment of the current economic backdrop? I mean, obviously we've got two front and center concerns: the Fed, we have trade. But let's kind of put that into context with the overall econometrics of today.
Right. So we have strong corporate earnings that we get some tailwinds from tax reform, which has created stronger both revenue and bottom line earnings. But then we also have headwinds that have been created now by a Federal Reserve that is raising interest rates. So, just like in February when the 10-year Treasury spiked and caused some volatility, we also have a bout of volatility because we saw the 10-year Treasury spike on the back door of the Fed meeting in late September. It'll be interesting to see tonight. We were talking about this earlier. Jerome Powell will be speaking in Dallas after the market closes. I think the markets will really pay very close attention to see if there's any dovish or more dovish commentary that could come out of the Fed based on that commentary this evening. So we'll see.
Sure.
And last week, when the Fed spoke, they weren't as hard line in terms of because the housing, situation has obviously with higher interest rates, housing will slow down in terms of new starts, in terms of the sales. There's really no refinancing right now. But this chart we're looking at, when you look at the consumer, consumer confidence, has continued to hit record levels. And even if you look at the CEO confidence, all of these are very, very solid historically, Paul, right?
Right. So, I mean, if we look at, the positives to this chart and the negatives, right, we try to strike a balanced note. Consumer confidence and small business confidence obviously doing a lot better than home builders and CEO confidence. Home builder and CEO confidence, as you can see, by the other two lines, the greenish line, we're seeing a bit of weakness there, and that's mostly attributed to, again, trade and interest rates. But if we look at the overall average trend of those lines collectively, they're still trending upward. The gray line or the gray period, shows a recessionary period, in the 08-09 era. As you can see, all of those confidence indicators tend to retrench collectively well before we enter that. So that's been another looming concern for a lot of clients. Are we on the brink of recession? We've got 2 indicators that indicate no. We have 2 indicators that are, really haven't resolved. We are paying attention to this. We, have 19 metrics that we follow. This is just a subset of the metrics that we follow. But we will, start to show concern if all of those lines start to collectively, go down. At that point, we'll start to revisit what our stance is on the market. But at this juncture, it's difficult to say that given the trend in unemployment. Wages are starting to grow. It's very difficult for us to, make that call and have that confirmation at this point.
Yeah, and inflation is, for the most part, under control. And even though as a company we experienced our health care this year, and even clients who are Medicare, historically they had a very, very low increase in cost. I think it was $1 something for their Medicare premiums. So, that's a positive note. When we look at in terms of, recession probabilities, as Paul was saying, you still see that, it's, pretty low. I mean, we had a speaker from Bloomberg, and, when we were looking at their leading indicator, it's not showing a looming recession. But at some point, the Fed can go too far, and a lot of times, John, you and I were talking, the Fed will go too far at some point, and possibly cause a recession,
Sure. I mean, I think if the Fed pivots and shows a willingness to pause, and we get positive news later this month out of the G20, we could certainly see a V-like recovery to this correction. But these things are dependent on those positive outcomes at this point. So we just have to pay attention. I mean, when we listened to Janet Yellen earlier in D.C. a few weeks ago, she spoke about the need to raise interest rates, but then she also spoke about the concerns that if Chairman Powell raises interest rates too quickly and too far, that it could cause a minor recession. So.
Yeah, and this, if we have a recession, most economists believe in the future. Most people are predicting it happens in 2020-21. Again, nobody knows. And again, we can have what's called a soft landing and just miss it and have a continued expansion. But again, we'll keep on top of this as we go forward. But as you see by this chart, we're in pretty good shape as we go forward.
Well, to your point, Roy, address some of the client concerns. To panic out of risk assets or stocks, if we would have done that in February and March, it certainly wouldn't have benefited client returns for the year. And if we do get a positive result out of the Fed, and we do see some traction on trade, panicking out of risk assets at this point, it would be a big mistake.
Right. Yeah. And corporate spending, if it does get resolved, I think the CEO index will spike on the positive side, because then again they'll be confident in speaking to some in corporate spending, speaking to some executives that are concerned about the tariff situation, so they're being a little more conservative in what they're doing in terms of
and rightfully
expansion.
so, right? Because whenever there's uncertainty in the marketplace, especially around cost of doing business,
they're going to get conservative. That makes sense. Right. So, consumer confidence. If you look at the Great Recession, where it fell, and where it is, it doesn't go straight up in a straight line. You see zigzags, but you see the zag is now positive, and we see that consumer confidence, is pretty high right now as we're going through, this period of time. Except again, if you're selling your home, you're not getting there's a direct correlation between interest rates and the price of homes. It has to be, because people can only qualify for a certain level of mortgage based upon the interest rates. So, I mean, that makes sense.
Yeah,
homes
we've
are
seen a
still
dip,
selling.
we've seen a dip in the last day or two as well with mortgage applications. And
Yeah.
that's normal when you see longer-term rates move up.
As most people out there, my first house I bought was over 10% in terms of interest rates, so we're still below 5. So it's not as if interest rates are still not very competitive. And I spoke to a client yesterday who just got a 10-year adjustable mortgage, meaning it's fixed for 10 years, which they intend to pay it off right below 4%. So rates are still they're not bad. They just we were used to 2 and 3% rates,
right.
and that's people got used to that.
I think, Roy, what the market is trying to resolve is the fact that it's really the Federal Reserve, U.S. Federal Reserve, that's on an upward trajectory for rising rates. And if you look at other central banks, if we look at the European Central Bank, the Bank of Japan, they're still really in zero interest rate territory. So the concern is, why are we raising rates too quickly? Because it has some negative effects. It strengthens our currency. It actually makes it more difficult. That's why a lot of international markets have been more negatively affected this year than normal, is because the dollar strengthened. They carry a lot of debts in dollar-denominated fashion, and it makes their debt burden more difficult. And then, of course, trade.
But also, when you look at Colgate and Procter & Gamble and J&J, these companies get more than 70% of their revenues in international markets. The stronger dollar is a negative impact. When you bring back the revenue from overseas, it impacts their revenue.
Right, and large cap U.S. companies at this point are almost all global multinational
and average significantly over 50% overall. And we're a global economy, and there's no getting away from that. It's not U.S. and everybody else. We're global.
So that's why I think it would be very interesting to see if the Fed Chair Jerome Powell does change his tone. Because like it or not, the U.S. is the global central banker.
Yep.
Our policy affects the ECB and the BOJ's policy. So for the Fed to just operate in a vacuum and not be cognizant of the global economic implications of their decisions, to me is
So I'd be interested to see on that note if later on this evening, if Powell takes a similar tone that Janet Yellen took back a few years ago, the last time we saw bouts of volatility, similar to this when we experienced Brexit.
Yeah, she backed right off at that point.
And markets tended to recover very quickly thereafter.
John, you also bring up a very interesting point. We've talked about this before. The Fed, one of their mandates is price stability. And price stability, not just inflation, but also to make sure that asset prices don't go up too far too quickly. So there's a couple of tools, right? They can use open market tools. They can increase the Fed funds rate, which they've postured to do one more time this year. But there's also another tool in their chest that they like to use, and it's really their policy speak, right? The market reacts based upon the Fed's language. So in order to create price stability or to make sure that asset prices don't get overinflated, just the Fed posturing about raising rates could in and of itself have the same effect as them actually raising rates by 25 basis points in December.
So, this slide we're just going to touch on. Well, this is really showing commodity prices, overall we've seen drop. I don't know about you, but it's nice to see us, even with 2 gas hikes this year by New Jersey, to see a 30, 40, 50 cent drop at the pumps. So again, from an economic standpoint, that gives consumers more dollars in their pocket. And again, our speaker recently at Bloomberg said it's very, very positive in helping us here. So let's get to, U.S. and international market valuations. The U.S., if you were around during the 2000s, which most of you were, and, we've gone through a period of time in the 2000s where international significantly outperformed the U.S. People forget that the S&P lost money during the decade of the 2000s, first decade, and international stocks, emerging markets, and performed well. And, Paul, in terms of, let's talk in terms of, what's happening from a valuation standpoint overseas.
Sure. So, if you look at how U.S. and international markets reacted last year, there was a global growth story, or story of revived global economic growth, and they pretty much moved in lockstep with one another. It was up really until January with, again, the two biggest underpinnings, Fed raising rates and global trade concerns, where we started to see divergence in valuation. So the red line being the S&P 500, the green line being the MSCI All World or All Country World Index minus the U.S. Seeing a big difference in returns. And again, the international markets really need to resolve trade and also need to resolve the fact that they're in a higher dollar environment. We were going to put a chart of U.S. dollar strength historically. It's strengthened a lot this year, much to the contrary of most opinions. Something tells me we're probably at the last bout of strength here, given the fact that the Fed actually may take a slightly more dovish tone. Also, if other central banks start to raise rates, that's going to actually take some pressure off the dollar. But those headwinds are basically telling us that the divergence here, either states that the international markets need to converge with the U.S. markets, or the U.S. markets need to converge, or they both sort of need to move closer together. Historically, to have that much of a divergence has not really been the case.
Yeah, in terms of the S&P, in terms of fair value, this is really, we can spend an hour on discussion, but this is just showing you in terms of where we are, where most economists and analysts are expecting high single-digit earnings increases as we go forward in the next 12 months. And there could be some positive surprises. I was at a meeting where somebody spoke recently about tax refunds.
Right.
So we'll have to see how, from an economics, but most people are saying we're going to have high single digits in terms of earnings gains, which should be positive for the markets as we go forward.
Right. So this, fair value model that we're citing here is Bloomberg's. We have our own version of it. It has similar inputs. Takes into account what the earnings growth expectation is for the S&P 500 next year, as Roy cited. We're expecting, probably a 10% earnings growth figure, but it also incorporates higher interest rates, because higher interest rates is a discounting mechanism for that fair value estimate that we'll be posing, or that Bloomberg poses. So even incorporating 4 more rate hikes, December and 3 more into 2019, we're still, arriving at, and our fair value estimate on the S&P is actually slightly lower, is about 29.52 versus 29.77 for Bloomberg's. But it just goes to show you that, given the retrenchment that we had last week, if we look at the fundamental backdrop, if we look at where expectations are, there is a potential, to have, from here, at least over the next 6 to 12 months, the chance for a nice recovery in the market. So, we don't want to be too short-termist. We don't want to be, alarmed by one month of volatility, which most of the drawdown occurred within 2 weeks, to predicate what our investment decisions are going to be.
In a big part, put it in perspective, in looking, and I remember in 1997 as an example, we had the Asian currency, we had long-term capital, we had a lot of things happen in 1997. But yet in 97, we had nice double-digit returns in the market, but yet we had a 20% correction at some point, technically a bear market. Even 2011, some of the asset classes got into bear market territory.
Right.
Just like this month.
Right. Some asset classes, such as oil, got into bear market.
Some tech companies, some larger tech companies.
Right. I mean, they said 65% of the S&P, was down over 10% as of yesterday.
It's been a broad trend for this year. If you look at all of the sectors that comprise the S&P 500, from the first drawdown that we saw back in February, the drawdown was led by certain sectors, right? Earlier on in the year, it was financials, energy, and then the market worked its way through consumer discretionary, staples. Up until recent, most of the negative attribution in the drawdown for the S&P 500 has been tech. So it's not as if all the sectors in concert with one another went down 15 or 20%. It's been certain parts of the market. So, one could argue that throughout the course of this year, we've had a rolling 12-month bear market. It's just that it's been done in phases, so it doesn't seem as drastic to the market participants out there.
And I think a key as we go through this volatility is really, and we talk about this as a team all the time, is really stay focused on your goal in terms of that's why we have diversification within the portfolio. Because, again, some of these, when I'm looking at this chart, which is very difficult to see, I'm sure, by participants in this call, there's always something going on. And some of these years, where major things happen, I mean, the markets do have great returns.
Right.
But it's normal to have a correction. It's normal to have a bear market every once in a while, even during a period of expansion.
Sure.
Right, John? We were talking about that. I mean, it's not uncommon.
I mean, it's been a very we've had a very long expansion, and during the course of this expansion, we've had several corrections. Certainly, this one doesn't. There's no implications through this correction turning over as an economy at this point. So it would behoove us as investors to be prudent, to be patient, to allow the asset allocation and diversification to work, and to periodically rebalance portfolios in order to take advantage of the opportunities that the volatility presents itself.
Yeah, and again, we're trying to position the portfolios to withstand a lot of this. But again, last month, a lot of people were surprised and shocked because of the severity of it in a 1 month period of time. And so we want to have this call just to have an intelligent discussion about really what happened. So I appreciate everybody's time, and I'm going to hand it back to Cherie. Thank you.
Once again, thank you for joining us on this webcast, and we look forward to continuing our series of these calls with you in the future. If you missed any part of this webcast, a replay will be available on our website shortly, hopefully later this afternoon. We really do appreciate your feedback, so please feel free to send us an email with your comments to pwm@prestigewmg.com. Thank you very much.